We're going to start with problem number 3 on, well, it starts on page 127 and then continues on page 128. So we're going to start by using T accounts, just to show you the posting aspect of T accounts. So we've got cash. Oops. This is problem number 3. On page 127. So we have cash. Accounts receivable. We have some supplies. And we have some computers. Office equipment. Dividends, let's see, accounts payable. Common stock. I agree. Dividends.
Does it matter what order
Now, I just put them all on a piece of paper. I'm just. Yeah, you need you need, like this one, we're going to put a lot of transactions in, and there's going to be a couple here, but the ones that I've made real short, we're only putting one transaction in, so you just need a line or two for those. So, and actually all of these last ones are very short. So tuition revenue. Salaries expense. Utilities. And then the last 3 are rent expense. Repairs. And advertising. All right, so these are all in the problem gave you all of those accounts, and it told you in that order set up T accounts for all of that. So our requirement now is that we're going to analyze the business transactions that occur for Sharon Potamus opens a secretarial school called Best Secretarial Training. And then there's an A through M on transactions to set this school up. And we're to analyze those transactions and then record them in the accounts that are affected. using the double entry accounting system. So there will always, for each and every business transaction that requires an entry, there will be 2 accounts at a minimum. There may be more than 2, but at a minimum 2 accounts for each one. All right? Everybody clear on what it is we're doing?
Where did you find what to put on?
It's on the top of page 128 in requirement number 1. It says set up the following T accounts: cash, accounts receivable, supplies, computer, office equipment, blah, blah, et cetera, et cetera. Okay? All right, so A, she contributed the following assets to the business in exchange for 28,600 shares of $1 par value common stock. So cash, so this is transaction A, cash of 11,400. So that's an increase to cash, so that's a debit. Computers of $10,000. So computers are property, plant, and equipment. They're long-term assets that we utilize in a business, same as desks and buildings and delivery trucks and the like. So computers, $10,000. So far we have 2 debits, because 2 assets, well actually 3 assets, we're going to do one more. There's office equipment for $7,200. So she contributed 3 types of assets to this secretarial school in exchange for all of the ownership of this corporation. All right? So the third one is office equipment for $7,200. And what did she get in return for giving all 3 of these types of assets to the business? She got stock of $1 par for $28,600. And if you add up the $11,400, the $10,000, the $21,400, plus the $7,200, that is the $28,200. And that is common stock. 28,600, correct. So that's our first entry.
So to give the credit for common stock, you always just add up all the assets.
All of the assets contributed. Yep. Yes, sir.
Can you explain what like $1 per
Par value is something. Corporations are incorporated under the laws of the state in which they're incorporated. And the states vary. Most states require that stock has a par value. That's a minimum par value. All right? Some of those states, not all, also have laws that you're not allowed to sell a share of stock for less than its printed par value. So a lot of states, a lot of corporations, when they incorporate, they set very, very low values for the par. You'll frequently see penny par value stock. Yes?
Par value is entirely arbitrary, right?
It's completely arbitrary. Yes. It is a decision that the organizers made when they incorporated the corporation. All right? Yeah.
So on this instance, you just have to meet the certain minimum value.
In this instance, because we're keeping it simple at this point, it equals. If she had contributed $40,000 in exchange for 30,000 shares of $1 par value, you would have used another account called paid-in capital in excess of par. It's another stockholders' equity type of account.
Well, she would have paid less.
She wouldn't have been allowed to. Yeah. So, because you can't sell it for less than the par in many, many states.
So she has $1 share.
$1 par value share. Yep. And so she contributed, and that's really what the value is, because she contributed fair market value, these equipment, these computers, and of course the cash is fair market value, it's cash. All right, so she gave that in exchange for all the stock, so the stock has, right now, a value of $1 a share. But that was her decision. She wholly owns that corporation. Does that make sense? We good? Okay. Transaction B. Found a location for the business and paid the first month's rent of $520. Because we're only paying 1 month's rent, this isn't prepaid. If she'd paid 6 months of rent or she paid 3 months of rent, it would have been another asset called prepaid rent. But she's only paying the first month's rent, so we're going to go ahead and expense it. Rent expense, B, is the debit, $520. What's the credit? It's the only way you can pay rent. Landlords won't take anything else. They're funny that way. Yes?
Why do you put the 520 on the credit side of cash?
Because you're spending it, so cash is going down. Assets go down with credits. And expenses go up with debits because expenses are in effect lowering net income, which lowers retained earnings, which lowers stockholders' equity. And you lower credits with debits. I mean, you lower stockholders' equity with debits. Okay? It's just the first one. So, C, paid for an advertisement announcing the opening of the school, $380. So of everything you see up here on the board, what does that sound like for the debit? Advertising expense. Just like rent, we're now spending more money to hopefully generate some revenues because we're announcing the school. And the credit, same. D, received an application from 3 students for 4 weeks of secretarial programs and 2 students for a 10-day keyboarding course. The students will be billed a total of $2,600. All you've done today is sign them up. They haven't come in, they haven't taken a single class, they haven't been billed anything. They will be billed in the future, but D, no entry. Nothing has occurred for D. So D, no entry. This is the same as ordering something, but nothing has actually occurred. E, we purchased some supplies on credit, $660. So we've purchased some supplies. We went to Home Depot, or not Home Depot, office supplies, Staples, and the credit is to accounts payable. E. On credit, yeah. So we went to the office supply store. We had set up an arrangement with them in advance, and they made an account in the name of the secretarial school, and we bought $660 worth of supplies. Yes, sir.
How do you get debit to accounts payable?
When you pay it, you will then lower it, because you'll lower cash and you'll lower the liability.
So you'll lower the credit?
Nope, you'll debit it. Yeah, and we've got one here. We're going to eventually pay this. Yeah, so you'll see it when we get to H. Is everybody good with E? F, we billed the enrolled students. So now they've taken their classes and they're actually issuing an invoice to them, and for more than what it was expected, $4,080. Yes. So F, $4,080. So that's the debit. What's the credit? Say it louder. Tuition revenue. 4,080. F. Because what does that do to stockholders' equity? Revenue that you earn is going to increase net income, which increases retained earnings, which increases stockholders' equity. And stockholders' equity, just like liabilities, are increased with credits. Accounts receivable is an asset. That's money that is owed to you by your, in this case, students. And will eventually, hopefully, be turned into cash. Yes, sir.
And how do you get the credit out of accounts receivable?
When you receive it. When they pay you, which they will here in J, item J, they'll pay you some of that, and then we'll...
And your cash goes up?
Cash will go up, and then accounts receivable, another asset, will go down. Yep. All right, everybody good so far? G, purchased a secondhand computer for $960 and some office equipment for $760 on credit. So we bought some more computers. So G, $960 worth of computer equipment, and we bought $760 worth of office equipment. How did we pay for it? Credit, which is accounts payable. Exactly. If you add the two together, that equals $1,720. Yeah, you might as well, for efficiency, add them together. You could have easily just, but you would have had to write accounts payable twice. G is the transaction. It'll still add up to the same. Is the other half, the credit side of the purchase of these computers and office equipment.
So when you mark it on your T account, you would mark it, like let's say you bought it from Office Depot.
Right.
Instead of putting G, you would be Office Depot.
Exactly. And the date, more than likely, and the invoice number and stuff like that. Yeah, there'll be all sorts of information on that that particular entry in a real computer system. Yep. Okay? Everybody good with that one? H, we paid for the supplies purchased up in E, $660. So now we're paying that payable. So we're going to lower the liability by debiting, and this is H, $660. And the only way our vendors are going to allow us to pay that is if we give them cash. Yes, sir. They're funny that way. All right. I paid cash to repair a broken computer, $80. Repairs expense. And cash. On J, we received partial payment from the students previously billed, $2,760. We're going to receive cash, so that's a debit increasing cash, $2,760. And what are we doing with the credit? We're going to reduce the accounts receivable by that same amount because they don't owe us that money anymore. K, paid the utility bill for the current month, $180. Utility expense, $180. And just like our vendors, CPS requires cash. God bless you. L, paid an assistant, 1 week's salary, $880. Salaries expense is the debit. Will your employees accept accounts payable? Probably they want the money, right? They're probably going to want actual cash. I promise I'll pay you next month. That will be a very awkward conversation. Don't have it right now, but I'll pay you next month.
So the L doesn't go anywhere else just because you're paying them cash?
You're paying them cash. Yeah, just regular. You do that every week in payday. You debit salaries, expense, and credit cash. Yeah, or a month, within a month. Well, you maybe just hired her at the end of the week, got so busy you had to have an assistant. During the first couple of weeks you were okay by yourself. And then lastly on M, you declared and paid a dividend of $600. Cash is going to do what? Go down, so $600 is the credit to cash. And the debit then is dividends. And this is how the owners of corporations get paid.
So every team should have some.
Well, yeah, in this case. In real life, you may have months where you don't use a particular account, but yeah. But in this case, we used every one of the ones they gave us because they gave us the ones up front. So, huh? I don't know. Yes, sir.
So in real life, as you're going through your accounts, you just add new T charts as you do?
Yeah, you add new accounts as needed. Yep, you sure do.
Why isn't computers under supplies? Why don't they go together?
Because computers you're going to use for more than 1 year, just like office equipment. And we'll have a whole chapter after we get through the second midterm about long-term assets, because we depreciate long-term assets. We buy them for more, and we use them for more than a year. Supplies we use probably within the next few months, because we'll expense those, and that's really chapter 3 and 4. We'll do that after the first midterm. But we'll expense those as we consume them. Nobody buys more than a year's worth of supplies in a single purchase, or at least you hope not. Yes, sir.
So why not put computers and office equipment under expense or under asset?
They are assets. All of the cash, accounts receivable, supplies, computer, and office equipment are assets. Accounts payable is a liability. Common stock and dividends are stockholders' equity. And then these are income statement accounts that flow into retained earnings. Yes, this is how we got there. Exactly. Because in chapter 1, we were doing financial statements based upon a trial balance. So now you can add up all of these accounts at the end of the first month, let's say, and do a trial balance and then do a set of financial statements. We're not going to do that, but you could quite easily do a whole complete set of financial statements from the data that we just did. So this is called footing. So we just draw a line down here and we add up all the debits, $14,160, and all the credits, 3,330, or 3,300, subtract that, and we get a balance of $10,860. That's the balance at the end of the period. In accounts receivable, we just have two numbers, so we don't have anything really to foot, but we wind up with a balance of $1,320. Supplies only has one account, so that's just $660. Computers has two, so that's $10,960 is the balance. Office equipment has two, that's $7,960. Accounts payable has $660 in debits and $2,380 in credits, which gives us a credit balance of $1,720. Common stock just has one account, as does all of the rest of these. And like I said, you could add up all of this and do a trial balance. You could put a listing here on the board of cash, accounts receivable, supplies, computer equipment, office equipment, accounts payable, all the way down, and list the debits and credits, and then produce a set of financial statements from that. Yes, sir.
So the balance left under accounts receivable, that's money they still owe you?
Yes, exactly.
Are we gonna have to make the statement on the test?
We are, but I'm going to review that on Wednesday. Yep. I give you a much more simplified set of T accounts, and you'll see that on Wednesday because I'll review it then. Yes, sir.
Will it be exactly the test?
It will, with the numbers will be different. Yes, sir.
Computers, is the balance supposed to be double underlined as well?
Yes, thank you. Yeah. Yeah. Everything has a balance should double underline that. Yes, sir.
Is the test going to have multiple, true, false?
No, it's just one big problem. Yeah.
So one problem then we need to do the financial statements and then the T accounts?
Yeah. You're getting ahead of yourself. Wait till Wednesday. I'll give you. What I'm going to do is I'm going to give you a set of T accounts printed on a piece of paper. You won't have to write them out. They'll be on a piece of paper already. I'll give you 5 transactions to record journal entries for, post them to the T accounts, get the balances of the T accounts, create a trial balance. It's not going to be complicated. They have 5 transactions. And then those transactions will then be, will create the income statement, the statement of retained earnings, and the balance sheet out of those transactions. Okay? Worry about that Wednesday. All right, does everybody understand this one? Because now I want to switch from T accounts to journal entries. So let's do problem number 5 now on page 128 and 129. Yes, sir.
For the balance under accounts payable, is that money you still have to pay?
Yes, that's the money that you owe from when you bought the office equipment and computer equipment. You still owe whoever you bought that from. Exactly.
So there'll be no such thing as a balance under the debit side of accounts payable?
It would be unusual. What has happened there is you have overpaid somebody. I'm not saying it never happens, but yeah, it's a mistake. Because all liabilities should have a normal balance of credits. All assets should have a normal balance of debits. That happens, sometimes, computer spits out 2 checks.
If you overpay it, can you add it to the accounts receivable?
Well, either that or get a refund back, yeah. And if you had done that at year end, that's exactly what they'll do. Just like if you spend more money than you have, because that's possible. That's more common. Let's say you had a credit balance in cash, because you've written checks and you mailed them on the last day, knowing that they're not going to cash them, because it's got to get there in the mail and then they got to deposit them. It's called playing the float, is what the term is. But if you do that and you have a credit balance in a cash account, they reclass that to accounts payable, because it's money that you owe people that you don't have the cash yet to pay. Hopefully on January 1st before they clear, or the 2nd, because nothing clears on the 1st because it's a holiday, that you'll have cash by then. That's the games. And they're difficult to do now, because now things don't clear as fast. They used to be that you could write a check for your East Coast vendors from your West Coast bank, and then that would take 2 or 3 days to clear. So everybody that you have located, physically located on the East Coast, you'd write them from a bank on the West Coast, and then do the opposite.
But now they do it.
Now you scan them and boom, they're cleared. You can't play those games anymore. Yeah. So, but sometimes a couple of days. That's interest that you get to earn overnight for, when you build that up to millions and hundreds of millions of dollars, it makes sense to do that. All right, problem number 5. Acorn Nursery School Corporation provides nursery school babysitting and child care programs. On January 1, it had the following trial balance. So this is a continuing business. So they had some cash and some accounts receivable and equipment and some buses and some liabilities and onward. During the month of February, the company completed the following transactions. So these we're going to do journal entries. So this is 2011. And on Wednesday, I'll be showing you the journal pages that we'll be using for the journal entries. Okay, so I'll show you what that is. February, and then 2nd is the first transaction. We paid the month's rent, $270. So we've already done that in T accounts. So what was the debit? Rent expense. Rent expense, $220, $70. And then the credit is to cash. We good so far? The next day, on the 3rd, we receive fees for this month's services. $650. Always do the debit first. So if we received the fees, how did people pay us? They paid us in cash. So that's the debit, $650. And what's the credit? Revenues. And in this case, it's service revenue. On number 4, we purchased supplies on account. So what's the credit? Supplies. And we bought $85 worth. And the credit? No, because it said on credit.
Do you have to indent the term?
Yes. Good question. It's all right. The credits, so that we can tell the difference. You can tell over here in the columns, but that you indent all of the credits also in the actual accounts. Yes, that's a good question. I should have mentioned that up front. Yes.
So for the number three,
Just put a little arrow. Even if you do that on an exam and you write it in pen, just put a little arrow in there that tells me that it needs to be indented, and that's perfectly acceptable. Yes, sir.
so the reason why the received fees for month services is cash is because you received them.
Right. Yeah, they said they received it. Yeah. If it was billed, then they would have said sent invoices for this month's services, and then that would have been a payment.
So and then the purchase supplies on the account is the same thing.
On account, it means it's by credit.
Okay, and like the listing of the steps, like
Mhm.
in the book, are those financial statements?
No, those are business transactions that are occurring. So we're going through, we're determining that yes, a recordable transaction has occurred, because it isn't always the case, and we'll have an example here of one that hasn't really occurred yet. We've then determined the monetary amount, and then we've classified the third step that's missing in that terrible true-false question that I throw out at the beginning of every semester. We determine the classification of what accounts are affected. So that's the three steps that we do each and every time there's a business transaction. All right? On the 5th, we reimburse the bus driver for gas expenses, $40. That's going to be the credit. What would be the debit? Something expense, yep. Gas and oil. $40. And actually in the problem, it says there are accounts, and it tells you supplies, dividends, service revenue, rent expense, gas and oil expense, wages, and utilities. So in the first requirement, it tells you all of the other accounts that are not in the trial balance already that are going to be utilized in this problem. And in this case, and it also tells you the account number, which I'll talk about here in a second. All right, number 6, on February the 6th, we ordered playground equipment for $1,000. No entry needed on the 6th, because all we've done is order the equipment. So that is not a recordable business transaction yet.
Like when you order things online, like the second you
Different. If we had ordered it and sent them a payment via credit card or cash or wire or something like that, that would have been different. Because at that point, we have a recordable transaction. We have sent cash. So for you, you've got inventory that you own it because you've paid for it, but you haven't physically taken possession of it yet. Now, I'd put it into inventory, or in this case, playground equipment. The moment I paid for it is where I'd put it. Either that, or I'd put it into prepaid playground equipment, just to keep it out of the fixed assets, to know that I haven't, because it's a deposit. They owe it back to you if they never deliver the equipment. So it would be a deposit of some sort, and I would list it as such in an asset as a prepaid. Okay? On the 8th, we made a payment on account. So we're making the payment. We are going to use cash, but what's the debit? Accounts payable. $170, yep. And cash is the credit. I can. No. No. I could have, but I didn't. Yes, sir.
I don't really understand that. You said that the cash is the debt, is the credit?
Correct. How are you going to pay a bill? Right. And so if you're paying it with cash, what's happening to your cash balance? Is it going up or down? It's going down. So how do you make an asset go down?
It's the credit on the cash.
Yeah, we're paying something that we paid for before, like maybe the supplies. Well, it's too much, but it's money that we owe somebody.
But the 170 in cash goes on the debit side of the accounts payable?
Yes, that's what the left column is. Yep. Yes, sir.
Is it okay if you write debit and credit all?
Absolutely.
I just want to just make sure I remember.
Yeah.
I'll let you guys how to be on the actual sheet.
On the sheet that I give you, it'll have debit and credit at the top. Yep. Okay? Everybody with me so far? Where are we at? The 9th. Receive payments from customers on account. So this is the opposite of the last one. So this one, what's the debit? Cash is the debit because cash is now going up because we're receiving a payment. Exactly. 1,200. And the credit is accounts receivable. On the 10th, we billed customers who had not yet paid for this month's services. $700. No, this is an entry. What is the debit? Accounts receivable. This is the opposite of the transaction above it. And the credit it's revenue, service revenue. It's no different because at the beginning of the month, some of our parents that were providing daycare to their children came in and paid us on the beginning of the month, on the 3rd, and they gave us cash, right? So this, at the a week later, are the ones that haven't yet paid us. So we're sending reminders out, you owe us for the daycare that we're taking care of your little child. Service revenue. Yes. Service revenue. 700.
So, for accounts receivable, credit is the money that they owe you? Is the credit the money you're about to get?
No, accounts receivable is an asset, just like cash. It's just not cash that you've received yet. So it's an asset of money that is owed to you from your customers. So it's a debit, because assets go up with debits. So as you send invoices out, you debit accounts receivable, and as they pay those invoices, you credit accounts receivable, and then debit cash.
Yeah, that's what I was asking.
Yeah, yes. When they pay you, you're going to credit, just like we did on the 9th here. That's exactly what happened.
But you just don't physically.
Right.
So like if you send someone a bill, then you put the amount of the bill on the debit side.
Yes.
And then when
And
they
then
pay, if we put it on
credit.
credit, the cash goes up.
Precisely. Yep. That's exactly right. All right. The 11th. we paid for supplies purchased on February 4th. So 2011. Yeah, I'm out of space, so I'm starting a new page. So if we're paying for invoices that were back on the 4th, so we bought some supplies for $85 back a week ago. So now we're going to debit the accounts payable, lowering the liability. And that was $85. And what's the credit? Cash. There's only one way. Cash is king. On the 13th, we received and paid cash for playground equipment that was ordered back on February 6th. $1,000. Equipment, exactly. And how are we paying for it? Cash.
Are they all gonna be cash?
Not necessarily. It could have said received equipment on account, in which case it would have been what? Accounts payable. Yes, sir.
For accounts payable, so the money, the $85 that you owe,
Right.
that goes on the debt side.
Now it does, because I mean, when we bought the supplies, we credited accounts payable, which increased the liability, and then on a week later, when we paid it, we lowered the liability by debiting it.
Wait, but okay, so your cash would go down on
Right.
the credit side.
Yep, because it paid off an invoice that you owe somebody else.
But why do you debit the accounts payable? Because now you don't owe my money.
Because you're lowering the liability. You don't owe that money anymore. All right?
Basically, accounts payable, the accounts got another like transitional period.
So the 17th, we purchased equipment on account. So this is the same debit, because now we're buying some more equipment of some type for $290. But we're not paying in cash, so accounts payable. The 19th, we paid this month's utility bill, $145. Utility expense. $145. And the credit is to cash. On the 22nd, we received payments for 1 month's services from customers previously billed. $500. What's the debit? Cash. Yeah, because cash is the asset is going up and accounts receivable, another asset is going down. $500.
How come you want to put this one down as a revenue?
Because this is really the payments from over here when we build these people on the 10th.
Wouldn't that still be revenue?
No, because this is where we took revenue. You'd be doubling the revenue. It's the same people. Right?
Oh, so now you're just lowering the.
I'm lowering the asset that they owe us. They don't owe us the 600 anymore. Now, how much they owe us? $100 left. So, okay?
Wait, but, we billed them for 700 earlier.
Yep, and now they're only 500 paid us. So, not everybody's paid us yet. Okay? All right, 3 more. Received, I'm sorry, the 26th, paid part-time assistance for services. Wages expense. Wages expense and a credit to cash. $460. No, it can be, but they gave us in the problem that wage expense is the account that they use. Yeah, yeah. Salaries is common. Salaries typically are salaried, that in wages are hourly. That's the difference. So a lot of companies have one or the other, but a lot of companies have both. Yeah. So you have salaried people that work in the offices and upper management, and then the hourly workers get paid by the hour. So 27th, purchase gas and oil for the bus on account, $325. So we've already used it, the gas and oil expense. Is it cash? Accounts payable. Yeah, it says on account.
So if you use it twice, then that's when it's accounts payable?
No, it's just to be purchased on account.
Yep. So this was just because it says it was purchased on account, whereas before we were reimbursing the bus driver for his purchase of gas and oil. And then the very last transaction, on the 28th of February, we declared and paid a dividend of $110. Dividend is the debit, and cash is the credit. 110. Yeah. Sometimes the numbers don't make a whole lot of sense. Yeah. Spend an entire month running a daycare with all the trouble that must bring, and you get $110 for your trouble. That would be a little disappointing. Yes, sir.
For number 22, the account when we billed when we receive the payment for
Right.
the services, why does the $500 we get, goes to credit side of the
Because what are we doing to the amount of money that is owed to us from our customers?